Another year, another pile.
People, business owners say that the previous accountant just gave a rule of thumb about how to calculate officer compensation.
Another year, another pile. Numbers stacked up mile by mile. It's time to sit, reflect, and add. Doing taxes ain't so bad.
I've heard some wacky things. Like, I've heard some people say that the accountant says that they should pay themselves $60,000 for every $200,000 of revenue from their company, and that's just crazy to me, because how are you going to prove that to the IRS if you ever get questioned? So that's why documentation is always very important when it comes to taxes. Okay, let's proceed. Why are S-Corps very important? Because it reduces self-employment tax. But something to consider, right? It's just because it reduces self-employment tax doesn't mean that it's a no-brainer that you should go with an S-Corp. You also have to determine, okay, what am I losing out in exchange to saving money on self-employment taxes? Because, yeah, you might be saving on self-employment taxes, but what if you're losing out on KPI deductions that's greater than the money that you're saving on self-employment taxes? So that's why it's very important to weigh everything out before making a decision of should you be an S corp, an LLC, or a C corp, right? Because even though it's said on the side that an S corp is more flexible and less complex than other structures, you also have to keep in mind that once you elect to be an S corp, you're stuck as an S corp for 5 years, and for that 5 years, you need to abide by the rules of the S corp. So you need to make sure that you know what you're doing, and that electing to be an S corp is the best move for you before you make that decision. So unfortunately, this is something that I've seen people make before. Clients come to me coming from another accountant, and they say that, oh, they put a property into an S corp, and they put properties in a C corp. And I'm like, oh my God, why did you do that? That most often is not a good decision to make. Why? Because when you put a property into a corporation like an S corp, you lose out on a step up in basis treatment. So what does that mean? So that means that if you put a property into an S corp, and then yes, you can do a 1031 exchange, which you can defer capital gains, you can defer depreciation recapture down the road. You can kick the can down the road. But the problem is you will not get a step up in basis when you pass away. So that means that when you pass away, your children or your grandchildren, whoever inherits the property, is not going to get the step up in basis when you pass away. So somebody's going to eventually have to pay that capital gains tax, right? So versus if you had the property under your own personal name or an LLC, let's say you buy it for $50,000 in 1980s, then you do 1031, and then let's say in 2030, when the property is $1 million, and then you pass away in 2030, you get the step up in basis, so that's $1 million as well to whoever inherits the property, which eliminates the capital gain. So you don't want that. And then another thing is that if you put a property into an S corp and then you try to take it out, that is a taxable distribution. So that's going to result into big taxes. So again, there's always exceptions to the rules, but for the most part, putting properties in an S corp not a good idea. Okay. All right. How about C corps? So C corp, similar drawbacks to S corps, no step up in basis. So don't do that. We actually had a client who came to us last year who did that. Terrible idea. I felt bad for them because there's really not much you could do once you make a mistake like that. Okay. Additional issues is that there's double taxation as well. What does this mean? A C corp is taxed on a corporate level, which is 21%, and then when it makes dividends distributions, whoever receives the dividends is taxed as well on a individual level. So there's where the double taxation comes in. Okay, we already talked about that. But when does a C corp make sense? So it's mostly for high income earners that's getting taxed at 37%, okay, or whatever's the highest tax bracket for that particular tax year. Okay, this is a great strategy for income shifting strategy. So imagine, right? You are a high income earner, you're getting taxed at 37%. But if you create a C-Corp and then you start a business, and then you can get that business's income get taxed at a lower 21% instead of a 37%. That's a great tool to use, especially if you don't need a dividend distributions. Okay, so that's a great one to use a C-Corp. All right. So again, it's not just about saving money on payroll taxes, but it's also looking at the big picture as a whole, right? Like considering QBI, considering dividends distributions, considering capital gains tax, considering step-up basis. You need to look at the entire picture, not just one or two things. Okay. So again, weigh out the pros and cons before making a decision on the legal entity choice, because it can really haunt you for multiple years down the line, not just the current year. So be careful. Make sure that you are working with somebody who knows what they are doing. Yep, so we were talking about this. If you do an S-Corp, you are locked in for 5 years. Okay? So proper setup is crucial. And not just a proper setup, but also analysis. Okay, analyze what's going to be the client's taxes if they stay as an LLC or sole proprietorship. Okay, what's going to happen if they become an S-Corp? What's going to happen if they become a C-Corp? What's the pros and cons for each one of those situations? And then once you weigh out all those things, then you can determine what is the best legal entity for the client. Okay, I'm so sick and tired of seeing social media posts, blanket answers, and blanket advice on, okay, if you have a real estate property, you should always be an LLC. If you have an active business, you should be an S-Corp. That is wrong. Like, you need to think more analytically and weigh out the pros and cons for each legal entity before making a decision like that. LLCs and partnerships, you get a K1 that gets taxed on your personal tax return. There's no corporate tax on S-Corps. C-Corps, you get taxed separately at a flat rate of 21%, and then whatever dividends and distributions a C-Corp makes, that's taxed on the taxpayer level again. So that's what the double taxation means. Okay. So again, there's no size that fits all. Okay. Everybody's situation is different. So that's why whenever a client comes to us and asks us what's the best legal entity for them, first we do a financial review to determine if they even qualify for different legal entity types. And then once we determine that they do, we do an entity analysis to determine what entity type is the best for them. All right, so here's a quiz, okay? So quiz time is, here it is. So if you get chosen and you answer this question correctly, we are going to give you a free tax assessment. A free tax assessment is a free call with me. You upload your tax return and I will give you 1 to 2 free tax tips that can save you money on your taxes from day one. This is a service that normally costs, $500 or more, but you're going to get it for free if you have been paying attention. So if you know the answer to this question, put it in the chat and I will pick out a lucky winner. Okay. So here's a question. What is the LLC's primary purpose? Okay. We're going to give a few seconds here to see if you guys have been paying attention. Okay. And then I'm going to pick out somebody from our lucky participants. Once again, I want to say thank you to everybody who joined today's call. You guys could literally be doing anything else, but you are here with me. So thank you again. All right, so let's see. Let me pick out a lucky winner here. So many people on this webinar. Thank you again. All right, we are going to go with, let's see. Wow. Okay, let's go with John. All right, John said the primary purpose of an LLC is to limit liability. Let's see if John is correct. Let's see if John gets a free tax assessment. Yes, John got it correct. Good job, John. Good job. So, John, congratulations. You got a free tax assessment. Please leave your email and your contact information in the chat, and our team will reach out to you about that free tax assessment. Okay. So, if you guys have any questions, you know where to reach us. Schedule a call with our team. You guys can also send us an email, send us a DM. We would love to help you. And remember, if you have any questions, don't worry. Your accountant handles that. I will see you at the next webinar. Thank you very much.
Time to sit, reflect, and add. Doing taxes ain't so bad.